Hello, good afternoon, everyone, and good morning to some of you. Welcome to this global macro conversation. This afternoon, our discussion will be focusing on fiscal policy. Some of you might have been attending on Monday our conversation about emerging markets. And tomorrow, we'll have also a very interesting panel about monetary policy in transitions. It's a great privilege to welcome this afternoon two very important guests. Commissioner Paolo Gentiloni from the European Commission in charge of the economy. Professor Gentiloni, welcome. Thank you for joining and accepting our invitations. And also a very well-known expert and academic, Professor Jason Furman, professor at Harvard University and Kennedy School. Jason, welcome and good morning to you. Thanks for joining very early this morning. As I mentioned, this topic will be on fiscal policy, who has been clearly the first line of defense for advanced countries, very different from the policy response for 2008. We will do it in a type of conversations for 45 minutes. And our moderator this afternoon will be Siegenthaler, the UBS macro advisor. Beat, good afternoon to you. And thank you again for your support. And I give you the floor to kick off the conversation. Beat, please.
Thank you very much, Mark. Thank you very much to our speakers for being here, and thanks to the audience for dialing in to listen to us. We have, as Mark has said, Paolo Gentiloni, who is the European Commissioner for the Economy in the von der Leyen Commission. He was Prime Minister of Italy from 2016 to 2018, Minister of Foreign Affairs before that in the Renzi government, and Minister of Communications 10 years earlier in the second Prodi government. And we have from the US, Jason Furman, Professor of the Practice of Economic Policy, jointly at Harvard Kennedy School and the Department of Economics of Harvard University. He served as the 28th chairman of the Council of Economic Advisors from 2013 to 2017, acting as both President Obama's chief economist and a member of the cabinet. So we have extremely well-placed experts on fiscal policy, both for Europe and the US. So we're going to talk, of course, about the specifics in these both countries or regions, and we have 45 minutes, as Mark has said. So we thought to start out, maybe we kick off with a slightly broader question. And I should say, I almost forgot that for our audience, please do send me your questions by email. I'll do my very best to pick them up and pass them on to our speakers. So in terms of that broader question, I mean, one thing, it used to be the kind of the old orthodoxy in economics used to be that you have a policy mix. There's on the one hand monetary policy, on the other hand there's fiscal policy, and you kind of, depending how much you do of the other, you do a bit more of the second one, and so on. But now in this crisis, it seems that an ever more popular view is that monetary policy just prepares the ground for fiscal policy to do whatever it takes. And so that there is a sense that kind of the old rules maybe don't apply or don't apply as much anymore. So maybe if I could start with you, Commissioner Gentiloni, how much for the EU and maybe more importantly for the euro area, how much has the framework changed? How much is kind of the Brussels view, so to speak, on fiscal policy different now than it was before the pandemic, or is just the same? Or would you disagree with that view that the rules might have changed to some extent?
Thank you for your invitation. Well, of course they have changed, and they have changed radically, I would say. Here we have a sort of proliferation of labels for this change. We used to refer to the Hamiltonian moment of the European Union, or Copernican moment for the European Union. we will see in 10 years from now. What is sure now is that for the first time, the European Union and the European Commission directly will issue a common debt to finance common purposes of common fiscal policy. And so for the first time, we can say that monetary policy, the one decided by the ECB, and fiscal policy are indeed going hand on hand, which is not obvious for our union, because, as you know, this is not a theoretical choice. It's only the consequence of on how the building of the European Union is and function. We are a union sharing the same currency, at least for 19 of the member states, but having different budgetary policy on each member state, and having a coordination fiscal policy based in the past fundamentally on common thresholds and on a mechanism of surveillance. This coordination was honestly completely unfit to face such a crisis. And I think we have to recognize that the boldness of the European institutions made possible to decide something unprecedented. So for the first time, we have a monetary policy, but also common fiscal tools in our fiscal policy. And they are, as you know, oriented to give a European added value to what we call the recovery. Because, of course, member states are spending for the recovery. They are spending on average 4.5% of their GDP, but and this was also enabled by the decision taken by the Commission of changing some of our fiscal and state aid rules. But to this, we are adding this common fiscal tool, which is concentrated on our strategic priority. So yes, of course, the Brussels views changed and changed a lot to face this crisis. And then we will see in the next months and years if this change will be a permanent one or only something addressed to face an emergency.
So before going more into the specifics of that fund, maybe if I could go over to Jason just also for that kind of general aspect, and in the US, I mean, there hasn't been so much emphasis of what's called fiscal space in Europe, given the unique situation of the US. How much, there's this MMT style view that fiscal spending has effectively become costless, at least as long as interest rates are zero. How much of that thinking do you think, or how much has that fiscal policy thinking changed over the last few months?
I think, thanks so much for including me in this discussion. I think our fiscal policy thinking has been changing over the last few years. And it hasn't been changing because of MMT. MMT is silly as a theory. It can't tell you when it applies, when it doesn't, where it applies. And the idea that monetary policy should be, the fiscal policy should be in charge of inflation management is, I think, a nutty way to do anything. But it's been changing the thinking about fiscal policy. You read what the IMF has written over the last 5 to 10 years, what the OECD has written, leading academics, et cetera. And it's changed not because of a new theory, but because the parameters have changed in the old theory. Interest rates have fallen. Interest rates were very low even before the crisis. Think of something like Maastricht. When the Maastricht Treaty was reached in 1992, German interest rates were 8%. Prior to the COVID crisis hitting, German interest rates were negative. So if you thought the right goals were 3% of GDP deficit and 80% of GDP, or 60 or 80, whatever percent of GDP debt back in 1992, you have to have different goals. You have to update that view now. We're also increasingly in a world where we hit the zero lower bound very early in a crisis, which happened in the United States, or we're already there when the crisis hits, as happened in Germany, which means fiscal policy needs to take a much more frontline approach. That's been more of a challenge for Europe than the United States, because things like the Stability and Growth Pact are asymmetric. They can compel deficit reduction, but not deficit increasing. And up until now, there was nothing resembling a common fiscal policy. The United States' challenges are we have weak automatic stabilizers because we have a relatively small government, and we have a legislator and president that can be from different parties and have a hard time legislating. So we saw that this year when we had a huge fiscal response up front, followed it up with no fiscal response at all right now. And so for the United States, the political inconsistency is the biggest danger. And I fear that's an inconsistency built into our system. In Europe, it's more that the institutions need to evolve and change as they're doing now to match the new parameters that the economy has.
And again, I would want to, of course, to come back to the specific US situation, but maybe first on Commissioner Gentiloni's side, again, in terms of that recovery fund, or I guess the official name is the Next Generation EU project. You know, in the job I do, speaking to investors, most I think investors, including in Europe, but particularly outside Europe, are a little bit overwhelmed trying to follow what exactly is happening or not happening, how much noise there is in terms of ratification, who needs still to decide. You know, I get these questions, people saying, oh, but I thought it was decided. Why are we still talking about delays and so on? Could you maybe explain for us in relatively simple terms as to the timeline where we go from here, what is still required for things to actually then being finally decided, and also when kind of the first bonds that you mentioned would actually be issued?
Yes. Well, I'll try to do my best, because it's, of course, as always, when something unprecedented happens, also the procedures is challenging. But I can tell you that this morning I signed 3 agreements for a general amount of 75, 80, 70 billion loans for a few number of countries in one of the programs of this recovery, which is called SURE, and is a program to support short-time work schemes. And this will be the first issuance, the first emission that the Commission is launching right now. It is 100 billion euros. Then we will have the second and bigger part of this common debt issuance, which is, as you say, the Next Generation EU. We are proceeding to the final agreement with the European Parliament. I am rather confident that we are near to the goal, and then we will have national ratification, and this regulation of this Next Generation EU will enter in force beginning of next year. And so the Commission will begin issuing bonds for this second and bigger tool next year. All in all, I think that the Commission will issue something like 900 billion in the next 3 years. And this is in some way explaining how innovative and completely unprecedented this is. A few other remarks on this next generation EU. We are receiving the national plans from all member states. We will approve them in the spring of next year. We gave to member states some guidance for these plans to concentrate on what we call our strategic transition. So 37% of the funding should be concentrated on the environmental transition and 20% on the digital competitiveness of our economies. The core message to our citizens is that the European added value is something looking forward, with the attempt to use this crisis and this unprecedented funding also to transform our economies and our societies. We don't need to go back to normal. We should try, and this is why we call it Next Generation EU, we should try to have, especially the common funding, targeted to make our societies more sustainable, more competitive, and more inclusive. Of course, the path of this new thing is never easy. We are not a federal state. We are a rather original building and construction, the European Union. But again, now we have, for the first time, a fiscal policy for the European Union with firepower. And this is something that since a few years, Mario Draghi before and Christine Lagarde in recent times always have been asking. We can't have, especially in the situation that also Professor Furman was describing, which is completely different from the Maastricht Treaty moment situation, this situation of the risk of a low for long, low interest rates, low inflation, low growth. We need a proactive fiscal policy to be added to our common monetary policy, because the monetary policy did a lot of good things for Europe, but we need to have also a common fiscal policy. And as always in our history of the European Union, if it works, it could be something that we use again in the future. Hamilton or not Hamilton, for sure, if it works, we will replicate this common fiscal tools in the near future.
Right, and so you said 900 billion over 3 years. That's obviously quite a big amount, and it could become some kind of a European safe asset, or it could be the start of it. But in terms of timeline, you say that the beginning of the year that should kind of be implemented. And we heard, I think, Chancellor Merkel insisting at some point over recent weeks that there should be no delay to that. So I guess two questions for me is there a potential for a delay? You say you're confident on the European Parliament, but are there any other sources that we could still get delayed? And then in terms of the practicalities, I mean, this is not something that the European Commission has done before. So what do you need to set up actually, and how far advanced or when do you expect the setup to be there so that the issuance can really be on a substantial scale?
Well, the first tranche of this issuance will be already this year, not next year, and it is this at least half of this 100 billion emission for the short time work schemes. So the SURE mechanism will be an emission in 2020, part of this 100 billion. We are building our own capacity, of course, cooperating with, first of all, with member states that have a huge experience in lending in financial markets, but also with financial experts and institutions. And the fact that we are beginning now with the first emission for this SURE mechanism of 100 billion will help us. And then, of course, in the next 3 years, we will have a level of emission quite high. The Commission has a AAA. We are also giving to these emission a sort of configuration connected to the strategic goals that we are choosing. For example, we decided that 30% of this next generation EU funding will be funded through green bonds, and that a substantial part of this SURE mechanism will be issued through social bonds. And of course, the consequence, as you were rightly saying, would be that we will have a sort of European safe asset with these emissions.
Jason, if I could come back over to you on the US side, and maybe one question, not necessarily just to do with fiscal policy, but just in general in terms of the US economy. It seems to have been more resilient than many had expected, despite even the lack of follow-up deal on the fiscal side. So I'm just curious what you see as the main driver of that resilience, and whether it makes you more optimistic for kind of the medium-term economic outlook for the US.
Yeah, I think the resilience is just that the CARES Act was basically 30% of GDP over the period it was. That was much larger than any estimate of the output gap, much larger than any lost income. And so we saw disposable personal income actually rise at a record pace in the second quarter of this year. It also gave states and localities in aggregate more money than their shortfalls. Some states got too little, some states got way too much. That meant that when we hit the fiscal cliff, households on average had more money in the bank than they had at the end of February. And states and localities had a certain amount of reserves too. And so they've been able to smooth their way through this fiscal cliff. The problem is, first of all, not every household. I'm telling you in aggregate, there's some that didn't get money. So there's some real suffering, people who aren't able to pay their rent, pay their mortgage, put food on the table, real human suffering. But the second thing is you can only smooth so far. The CARES Act was a bit bigger than was needed for its period of time. Right now, what we have is zero, which is a lot smaller than we need at this moment. Households are running through their bank accounts. Their cushion is depleting, and that's a reason that is contributing to the flagging economic recovery. Our level is in a better place than I thought it would be. Our rate of change is in a worse place than I thought it would be. We're 11 million jobs short. if you create 500,000 jobs a month, that would take 2 years to close that gap. I think we can do a lot better than that if we have a fiscal expansion. And so I don't think policymakers should be complacent because the sky didn't fall in August and September. It didn't fall because there was this big cushion from the first round. That cushion is going away. The complacency itself on the part of some policymakers is the biggest threat to a continued strong recovery in the United States.
And I just want to ask one question looking towards the election. I mean, the market seems pretty much assuming by now that Biden will win. I guess the prospect of a more expansionary fiscal policy in a Biden presidency is probably being priced as well. So just assuming that he would win, and just on a kind of a general, relatively general level, because unfortunately we don't have time to go into a lot of detail on this, but just the question of how much fiscal support we can expect from him, assuming, let's say, there is a Democratic sweep and the Democrats win the House as well, or the Senate as well. Because there does seem to be this tension. Of course, there is always a tension. You have to pay for it, but people have different views to what extent you can afford maybe to postpone payment further out. So, and we don't know a lot of what exactly the program would be. So, what would be your very broad expectation in terms of the medium-term fiscal policy under a Biden presidency with the Democrats in the Senate?
Yeah, in general, in the United States, the most fiscally expansionary governments are ones that are unified president and Congress. The chance of a unified Republican president and Congress are vanishingly small. The chances of a unified Democratic president and Congress are, I don't know, they could be as high as 50-50. In that case, I would expect you get a large upfront fiscal expansion. Some of it is the type of relief that we've seen, things like transfers through unemployment insurance, transfers to states and localities. But I think some of it would be more on a 1 to 5 year horizon with things like investments in infrastructure and greening the economy. The size of that will depend to some degree on where the economy is in January, to some degree on the constraints that some of the more moderate Democrats in the House put on it, but I would expect it in the sort of 7 to 15% of GDP range. Then separate from that, there will be a longer term Biden agenda. Much of that agenda will be paid for. It'll be things like healthcare, college, preschool, and the like, and pay for as being things like high income tax increases, and high income tax increases. And that'll get paired up. That second thing will be a little bit more complicated to navigate through the party, through the substance of drawing it up and the like. I think a really important part of that, since this is an international discussion, is international tax reform. I think there were some good things done in the Tax Cut and Jobs Act, but they really need to be changed. And the more we can cooperate and work together on things like international minimum tax, I think the better off we'll be.
I just want one quick follow-up question on that before we go to some of the questions from the audience. In terms of the tax hikes, which is always from market point of view something that generally that doesn't go down well. I mean, but in terms of how do you perceive the pressure within the Democratic Party if that scenario were to play out in terms of paying for things, in terms of tax hikes? What do you expect there, again, broadly speaking? Or has there been a change over the last few weeks and months in terms of both sides of the argument, how much leverage or power they have?
Right. I don't think any Democrat thinks you need to pay for emergency stimulus. I don't think any economist thinks you need to pay for emergency stimulus. So that's unpaid for. In general, I don't think there's much of a constituency for active deficit reduction, which is to say lowering the deficit below the baseline path it's already on. With interest rates so low, financial markets aren't asking for this. I don't think anyone thinks that's a top priority. So when President Clinton came into office, the first thing he did was deficit reduction. You won't see that under a President Biden. The question then is in between. I think the in between is pay for things. When you pay for things, it lets you continue on your baseline deficit path. If the deficit's rising, you allow it to rise, but you don't add any fuel to the fire. And the issue around paying for things will be, what exceptions do you make? Do you decide infrastructure pays for itself? Do you decide preschool pays for itself? Do you create some exceptions to that, or do you apply it strictly? And I think that'll depend on, the relative factions within the Democratic Party. And of course, all of this is premised on a Democratic Senate. If there's a Republican Senate, that would be a much less fiscally expansionary outcome for the United States and the world.
Thanks very much. So just for the last 10, 15 minutes, I got a few questions from people, maybe to starting with Commissioner Gentiloni. One question is, what would the policy reaction in Europe be in case of a double dip scenario? What could be done about European banks, or will a financial crisis become unavoidable?
Well, I think we have to act with all our means to avoid a double dip scenario. Lessons learned are important. So we have the experience of the previous crisis. Of course, the crisis we are now in is completely different, but the previous crisis gives us the message that we should not prematurely withdraw our measures of our supportive fiscal policy. As you know, we are now in a exceptional situation where our common fiscal rules are suspended. The procedures of this Stability and Growth Pact is suspended because we triggered a sort of escape clause. This escape clause will remain in place for sure for next year until the end of 2021. And then we will have a discussion on the future of our fiscal rules. So I think we should keep supportive our policies. We can avoid the double dip recession. We, of course, will face a very delicate moment because what we had in mind was a phasing out period of the strong fiscal measures in this autumn. But at the same time, we are experiencing a second phase of the pandemic in several European countries, bringing to limited measures of lockdown. And so we have to have a balance between this phasing out and the new infections raising and producing containment measures. So a very difficult phase in very crucial weeks when we will better understand the evolution of the pandemic. For sure, the phasing out is beginning because the recovery is underway, but probably it will be slower than expected just a couple of months ago.
And then just one more question is on inflation in Europe. Well, the question is, will we ever see inflation in Europe? What kind of fiscal impulse would be needed to get a sustainable rise in inflation? I'm not sure whether you have any view or you need to have any view, but would you, how hopeful would you be that what we have or what you have decided will make an impact on that side?
Well, in our reality and also in our forecast at the moment, we don't see big changes and different expectation from the level of low inflation that we are still in. Of course, this will also influence the discussion, which is not for the Commission, on our monetary policy, because there is for sure a review of the monetary policy from the ECB going on. Decision taken by the Fed are obviously observed very accurately here in Europe. So it is possible that we have to have in mind that a low inflation situation will last for a certain amount of time.
And maybe, Jason, to you, kind of a similar question in terms of inflation, whether what kind of fiscal expansion would it require, you think, for the US, for the Fed to kind of reach the target? And is this going to become a constraint over the foreseeable future in any way?
I don't think inflation will be a constraint in the foreseeable future. I think if I'm wrong, that would be a pleasant surprise rather than a disappointment. If we end up with lower real interest rates facilitating investment and home buying, lower real wages speeding a return to full employment, and more deleveraging, all of that is good stuff that would happen as a result of inflation. If we did a $2.5 trillion fiscal stimulus every 3 months, I think we would have a demand that would exceed supply. Even that, I'm not sure would cause inflation. It might just cause saving to skyrocket in the way we've seen in recent months. But that would have the prospect of causing inflation. I don't think we'll have anything like that magnitude of fiscal response. And so I think we're going to be below 3% inflation for some time to come, which means on any sort of reasonable interpretation of the Fed's goals, well within the averaging that they're aiming for.
And then one more question on the US debt, and it sounds to me like I forgot, but that question might have come from a Swiss investor or like myself, always worrying a bit about the debt burden. So the question is, how can the US manage its debt load in the next decade while staying competitive? And will the Federal Reserve be able to continue monetizing the US debt without adverse reactions from the market? Well, I think we should ask the markets that. But I mean, do you see? Is there a scenario where you would worry about the level of debt in the US over the next 1, 2, 3, 4 years?
Over the next 1, 2, 3, 4 years, very little scenario in which I'd worry. Interest rates are extremely low right now. I don't think that's just an artificial thing by the Fed, because remember, the Fed pays for borrowing debt by issuing more debt. It pays interest on reserves. Right now, it's paying very little interest because that's the market rate on those reserves. But I don't think you want to think about it as monetizing debt in a world where reserves are now paying interest. I think 150% of GDP, to me, it's very hard as a level of debt. It's very hard for me to muster a strong argument against that, especially since even at that debt level, your interest payments as a share of GDP would be similar to what they've been historically. And I think looking at real interest payments as a share of GDP is the right way to think about where you are. Now, even to asymptote to 150% of GDP would require some adjustment for the United States. Right now, we're on course to rise even above that. So I think some modest fiscal adjustments are needed. I don't think they need to happen in the next 2 or 3 years. and I don't think the adjustments need to be very large. And I'm not, I think a bigger threat to American competitiveness would be if we worried too much about the deficit. That would threaten our competitiveness much more than our debt threatens it.
And then back to Commissioner Gentiloni, maybe for one last question, or there's two questions. One is kind of, again, a bit more specific, about the issuance. Of course, on the market side, that's quite a big deal if that potential start of the of a safe asset. At which point do you plan to give out more information about maturities, about kind of issuance plans, and so on? Is there already anything you can say at this point? And then on the also on the same issue, that this is, well, I guess you will say yes. Is this going to raise the role of the euro in international markets, and be kind of maybe support the euro in the competition with the dollar and maybe the renminbi at some point in the future? But obviously, I mean, I guess that's clear. That's going to be a positive for the euro as an international currency.
Yes, indeed, it will. It is not the principal goal of course of our recovery strategy, but it has a side effect for sure. I think we will strengthen the role of the European single currency at the global level, and we are still facing consequences in the exchange rates, because the message to the markets, I think, of this surprising common response of the ECB and then of the Commission and the European Union was a very strong reaction, and this also had consequences in our exchange rates and in the global role of the euro. As far as the emissions are concerned, well, the clear schedule is coming for the first one that I mentioned you before, the one of this sure mechanism and of this 100 billion euros in two tranches, the first one this year and the second one January, February, and I think that in these very days we are beginning to give to the markets the right informations in maturity, timing of the emissions, etc.
Thank you very much. And then also just a last question for Jason in terms of just touching slightly on the Fed, with the recent strategy change. I would imagine you thought that's overall a positive step, as almost everybody thought actually. But do you think there's going to be any risk of, people call it fiscal dominance, maybe one should call it political dominance at some point? I mean, the more the Fed or any central bank is committed to solve broader and broader problems, the more at some point, if these problems are not solved, there's going to be a backlash. Do you think there's any reason to worry there?
So first, I just want to say thank you for including me in this discussion. Listening to the commissioner for me was the highlight of my day, just knowing the great hands that European fiscal policy is currently in. So I think that was terrific. I'm going to give a brief answer, and then unfortunately I'm going to have to click the leave button to make it to something else. The Fed was assigned two primary goals: maximum employment and price stability. I think its new goals are consistent with better achieving those goals. I think as long as it's achieving those goals, it will have broad public support, broad political support. I wouldn't call achieving those goals fiscal dominance. The fact is it wasn't achieving those goals for the last decade. It was consistently too low on inflation. It was missing its target over and over and over again. I think this will help it better hit its target. So this is not fiscal dominance. I think there's a very small tail risk that a president appoints some crazy Fed chair. If they did, with President Biden, I think there's zero chance. With President Trump, it's a bit higher. If they did, there'd still be all these regional presidents. There'd still be all these governors whose terms were lingering. To move the whole committee into a very, very different mode, I think would be nearly impossible. But anyway, thanks for including
Thank you very much, Jason, and thank you very much, Commissioner Gentiloni, and to the audience. Thank you very much, and hope to speak soon.
Thank you. Grazie.